Human capital contracts sound like a Ray Bradbury nightmare made flesh, but they are in fact fintech's solution to student funding. In the US, platforms allow investors to lend money to students in return for a percentage of their future salaries. In the UK, where government student loans are already income contingent, another market in university funding is blooming. Last week, Cardiff University raised £300 million with a 40-year bond that the Welsh University plans to use to build new facilities. At 3.1%, that's an 85 basis point bump on equivalent gilts, particularly attractive if you think the British government will bail out public sector institutions from financial mishaps between now and 2056. There has been a rash of bonds issued by English and Welsh universities in the last couple of years as the public sector tries to bridge funding gaps left by austerity policies. All have offered the sort of multi-decade maturities and gold-plated credit ratings beloved by pension funds and insurance companies, and they have been extremely popular in markets. With steady income from tuition fees, handsome endowments, and the supposed backing of the state, investing in university bonds sounds appealing. But the Higher Education Funding Council for England has pointed out that university finances operate with only a slim margin for error. The reason for building shiny new facilities is in part to attract more international non-EU students who pay 3 times as much to attend university as domestic students. But a populist pledge by the Conservative Party to cut immigration numbers is turning away international students. Last year, the number of new students from outside the EU fell by 3%. If you're tempted by university bonds, you need to keep a close eye on the UK's visa rules.